Did you know that 90% of traders lose money not because they lack market analysis skills, but because they fail to master their emotions? The stock market, forex, or crypto trading isn't just a numbers game. It's a psychological battlefield. Fear, greed, and impulsive decisions can wipe out your account faster than a bad trade. But here's the good news. With the right mindset and psychological tools, you can not only survive but thrive in the markets. In this guide, we'll explore 7 critical psychological skills that will transform you from an emotional trader into a disciplined, sustainable one. These skills aren't about quick riches or overnight success. They're about building a foundation for long-term profitability. Whether you're a beginner or a seasoned trader, these lessons will help you protect your capital, stay calm under pressure, and trade with confidence. Let's dive in. Adjust your expectations. Trade with realism. Every trader dreams of hitting the jackpot, turning a small account into millions overnight. But let's be honest, trading is not a get-rich-quick scheme. Unrealistic expectations are a recipe for disappointment and reckless decisions. When you expect to double your account in a week, you're more likely to overtrade, take oversized risks, or chase losing trades. Take Sarah, a beginner trader who started with $5,000 and expected to make $50,000 in a month. Fueled by hype from social media gurus, she went all in on a single trade. When the market turned against her, she lost 80% of her capital in one day. Devastated, she quit trading, blaming the market. The real culprit? Her unrealistic expectations. How to adjust your expectations. Set achievable goals. Aim for consistent small gains, e.g., 1 to 2% per month, rather than astronomical returns. Focus on the process. Measure success by how well you stick to your trading plan, not just profits. Accept losses as part of the game. Even the best traders lose 30 to 40% of their trades. It's about winning in the long run. By aligning your expectations with reality, you'll trade with patience and avoid the emotional roller coaster that leads to bad decisions. 2. Master risk management. Protect your capital. Imagine this. You've analyzed the market perfectly, spotted a sure-thing trade, and gone all in. The market moves in your favor, then suddenly reverses. Your account is wiped out. Sound familiar? This is what happens when you neglect risk management. Risk management is the backbone of successful trading. It's not about how much you can make on a single trade. It's about how much you can afford to lose without destroying your account. The golden rule? Never risk more than 1 to 2% of your capital on a single trade. Consider John, a forex trader who risked 50% of his $10,000 account on a single EUR/USD trade. He was confident, but a surprise news event caused a sharp market drop, and he lost $5,000 in minutes. Had he risked only 1% $100, he could have survived the loss and kept trading. Key risk management tips. Use position sizing. Calculate your trade size based on your stop loss and risk tolerance. Diversify trades. Don't put all your capital into one asset or market. Have a risk-reward ratio. Aim for trades where potential reward is at least 2 to 3 times the risk. By prioritizing capital preservation, you'll stay in the game long enough to seize profitable opportunities. 3. Control your emotions. Tame greed and fear. Trading is an emotional roller coaster. One moment, you're euphoric after a winning trade. The next, you're paralyzed by fear as the market turns against you. Greed pushes you to overtrade when you're winning, while fear makes you hesitate or exit trades prematurely. Both are your worst enemies. Meet Alex, a crypto trader who made $2,000 on a Bitcoin trade. Elated, he doubled his position, ignoring his trading plan. When Bitcoin crashed, he lost $5,000. His greed turned a win into a devastating loss. How to control emotions. Stick to a trading plan. Write down entry, exit, and risk rules before placing a trade. Practice mindfulness. Take deep breaths or step away when emotions run high. Automate decisions. Use tools like stop loss and take profit orders to remove emotion from execution. By mastering your emotions, you'll make rational decisions and avoid the traps of greed and fear. 4. Know when to rest. Avoid burnout. Trading 24/7 doesn't make you a better trader. It makes you a tired, irrational one, constantly staring at charts, chasing every market move, or trying to recover losses can lead to burnout and poor decisions. Lisa, a day trader, spent 12 hours a day glued to her screen, desperate to make back a $1,000 loss. Exhausted, she misread a chart pattern and lost another $2,000. Had she taken a break, she might have returned with a clearer mind and better judgment. How to know when to rest. Set trading hours. Limit your screen time to avoid fatigue. Take breaks after losses. Step away to reset your mindset. Prioritize self-care. Sleep, exercise, and a healthy diet improve focus and decision-making. Rest isn't a luxury. It's a necessity for sustainable trading success. 5. Learn from mistakes. Turn losses into lessons. Every trader makes mistakes, but the best ones learn from them. If you don't analyze your losses, you're doomed to repeat them. A trading journal is your greatest ally. It's like a map that shows where you went wrong and how to avoid those pitfalls in the future. Take Mike, a stock trader who kept losing on tech stocks but never reviewed his trades. After months of losses, he started journaling every trade, noting entry-exit points, emotions, and market conditions. He discovered he was chasing trends too late. By adjusting his strategy, he turned his losses into consistent gains. How to learn from mistakes. Keep a trading journal. Record every trade, including why you entered and what went wrong. Review weekly. Analyze patterns in your wins and losses. Seek feedback. Discuss your trades with a mentor or trading community. Losses are tuition fees for the market's lessons. Pay attention, and they'll make you a better trader. 6. Use stop-loss orders, your safety net. A stop-loss order is like a seatbelt. It won't prevent a crash, but it can save you from catastrophic damage. Yet, many traders avoid stop-losses, fearing they'll be stopped out just before the market reverses. The truth? A properly placed stop-loss protects your account from unpredictable market swings. Emma, a futures trader, refused to use stop-losses because she didn't want to lose on a trade. When a sudden market drop hit, she held on, hoping for a reversal. The market kept falling, and she lost 70% of her account. A stop-loss would have limited her loss to a manageable amount. How to use stop-losses effectively. Place them strategically. Set stop-losses based on technical levels, e.g. below support, rather than arbitrary amounts. Avoid tight stops. Give the market room to breathe to avoid premature exits. Stick to your stop. Don't move it further away in hopes of a reversal. Stop-losses aren't your enemy. They're your shield against the market's volatility. 7. Cultivate discipline and patience. Wait for the right moment. Successful traders aren't the ones who trade the most. They're the ones who trade the smartest. Discipline means sticking to your strategy, even when the market tempts you to act impulsively. Patience means waiting for high-probability setups instead of jumping into every market move. David, a swing trader, used to trade every day, chasing small price movements. His account barely grew, and he was constantly stressed. When he adopted a disciplined approach, waiting for clear chart patterns and strong signals, his win rate improved, and his profits soared. How to build discipline and patience. Follow a trading system. Define clear rules for entering and exiting trades. Avoid overtrading. If there's no clear opportunity, stay out of the market. Practice delayed gratification. Train yourself to wait for the best setups, even if it means missing some trades. Discipline and patience are the cornerstones of trading success. They turn chaotic trading into a structured, profitable process. Conclusion: take control of your trading journey. Trading is as much about mastering yourself as it is about mastering the markets. The 7 psychological skills we've discussed, adjusting expectations, managing risk, controlling emotions, knowing when to rest, learning from mistakes, using stop losses, and cultivating discipline and patience are your roadmap to sustainable success. Start small. Implement one or two of these skills and track your progress. Over time, you'll notice a shift. Fewer impulsive trades, less stress, and more consistent results. The market will always be there, but your capital and sanity won't if you let emotions take the wheel. Your challenge? Reflect on your trading. Which of these mistakes have you made? What's one skill you'll commit to improving this week? Share your thoughts in the comments, connect with other traders, and keep learning. Follow for more practical trading insights, and let's build a community of disciplined, profitable traders together.